Property insurance premiums across the United States have surged at some of the fastest rates we've seen in decades. In some regions, commercial insurance costs are up 20, 30, even 50% year over year. Landlords are feeling it, lenders are reacting to it, and investors, especially those invested in shopping centers, need to understand exactly what this means for net operating income, valuations, and long-term returns. In this video, we're going to break down why this insurance shock is happening, how it impacts shopping center investments, and how conservative underwriting helps to protect investor capital when unexpected costs show up. And yes, before anyone asks, no sport coat today. It's a Friday, but the facts are still fully buttoned up. Let's start with what actually changed. Insurance carriers across the country have been repricing risk aggressively. Several forces are converging at the same time. Natural disasters are becoming more frequent and more expensive. Construction costs have risen sharply, increasing claim severity. Reinsurance markets have tightened globally. Risk models have become more conservative, and in certain states, insurers have simply stopped writing new commercial policies altogether. The result is that fewer carriers are competing for coverage. There's higher premiums, lower coverage limits, and a much larger deductibles. It isn't a short-term blip, it's a structural reset in how insurance risk is being priced. So what does this mean specifically for shopping center investors? Insurance is a core operating expense. In most shopping centers, it flows through CAM, common area maintenance, meaning tenants ultimately bear much of the cost. But pass-throughs are not frictionless. When insurance premiums jump 20 or 30% in a single year, some tenants can absorb that increase. Others cannot. Smaller tenants, service businesses, and restaurants often operate on really thin margins. Sudden expense spikes can strain their economics and in some cases threaten occupancy. For owners, rising insurance costs affect multiple layers of investment. They reduce net operating income. They increase volatility and cash flow. They complicate refinancing conversations with lenders, and they directly impact valuation as investors demand higher returns to compensate for higher risk. In extreme cases, deals fall apart mid-transaction because insurance quotes come back materially higher than what was underwritten. It's also important to understand that not all shopping centers are impacted equally. Older centers with deferred maintenance, aging roofs, outdated electrical systems, or poor loss histories are being hit the hardest. From an insurer's perspective, these assets simply carry more risk. Centers located in coastal markets or regions prone to wildfires, floods, or severe storms, they're facing especially sharp increases, sometimes alongside coverage restrictions that didn't exist just a few years ago. On the other hand, well-maintained, necessity-based shopping centers tend to fare better. Grocery-anchored centers, medical retail, and service-oriented tenant mixes generate consistent traffic and predictable cash flow. Those characteristics matter not just to investors, but also to insurers and lenders. Strong tenant credit and stable occupancy don't eliminate insurance risk, but they make it easier for a property to absorb higher costs without destabilizing the investment. This is where conservative underwriting becomes critically important. Conservative underwriting also influences how we structure our capital. Higher expense volatility means we prefer moderate leverage. It means we prioritize debt structures that can handle short-term noise without forcing reactive decisions. And it means we evaluate tenant durability very carefully, especially their ability to absorb CAM increases without destabilizing their business. We don't assume that expense increases will always be fully passed through without consequence. We assume friction, and we plan accordingly. This approach doesn't eliminate risk, nothing does, but it dramatically reduces the chance that a single unexpected cost can derail an otherwise solid investment. So what should shopping center investors be thinking about right now? First, understand your tenant mix. Centers anchored by grocery, medical, and essential service tenants are better positioned to weather expense volatility than those dominated by discretionary or labor-heavy tenants. Second, pay close attention to property condition. Roofs, HVAC systems, parking lots, and electrical infrastructure all influence how insurers view risk. Proactive capital investment can reduce both insurance exposure and long-term operating costs. Third, scrutinize underwriting assumptions. If projected expense growth looks unrealistically low, that's a red flag, especially in today's environment. And finally, align with operators who plan for uncertainty instead of assuming it away. The great insurance shock is not the end of shopping center investing, but it's a reminder that real estate is an operating business, not just a financial model. Unexpected costs will appear, markets will reprice risk, and assumptions will be tested. At Rockstep Capital, our philosophy has always been to stay nimble, remain disciplined. That mindset doesn't just help investments survive shocks like rising insurance premiums. It positions them to perform through full market cycles. Thanks for watching, and see you next time.